Good afternoon, everyone. This is Barbara Huffman, Director of Communications here at Messer Financial Group. We had a little bit of a technical glitch with this original presentation on Wednesday, April 20th. So Trevor Keeble, Director of Product Training for AIGPartners, has agreed to come and present the material again because it was a great presentation, very important material, and we wanted you to have the benefit of hearing what Trevor has to say. Trevor, take it away.
Thank you so much, and good afternoon again, everyone. As Barbara mentioned, my name is Trevor Keeble, and I'm the Director of Product Training here with AIG. A couple of things we're going to go over today. We're going to talk about our Quality of Life Flex-Term product. We're also going to talk about a bundle discount program we have called the Quality of Life Advantage program. We're going to start, though, by discussing the real value proposition of our Quality of Life insurance suite of products, and that is our living benefits. And then at the end, I'm actually going to spend just a couple of minutes providing you with some exciting new teasers, basically, on some new product stuff that we have coming out very, very shortly that I think you will all find certainly of great value. So we'll go ahead and begin. As I mentioned, we're going to start with the living benefits. We're calling these our Quality of Life SelectChoice Accelerated Benefit Riders. And there's three layers of these accelerated benefit riders. We have a chronic illness rider, we have a critical illness rider, and we have a terminal illness rider. What these riders are going to allow the client to do is to accelerate all of or a portion of their death benefit up to $1.5 million in the event they become critically, chronic, or terminally ill. So from a chronic illness perspective, to be qualified as chronically ill, they have to be unable to perform 2 of the 6 activities of daily living, or require substantial supervision by somebody else to protect themselves from threats and safety due to severe cognitive impairment. That, of course, is just a fancy way of saying something like Alzheimer's disease. So, you're chronically ill if you're unable to perform 2 of the 6 ADL, or if you have Alzheimer's disease, and if you meet that criteria, you can accelerate 100% of your death benefit up to $1.5 million. Same from a critical illness perspective. Same parameters from the 100% up to $1.5 million, and you can see the list of the critical illnesses there on your screen. Major heart attack, coronary artery bypass, stroke, invasive cancer, blood cancers, major organ transplant, end-stage renal failure, paralysis, coma, and severe burn. If you're unlucky enough to suffer one of those critical illnesses, you qualify for the acceleration. And lastly is the terminal illness accelerated benefit rider, which we define as having a life expectancy of 24 months or less. With these riders, with the SelectChoice Accelerated Benefit Riders, the whole value proposition of the Quality of Life insurance is that these are no-cost accelerated benefit riders that are automatically included on all eligible Quality of Life insurance products, even our term policy, which we're going to talk about here in just a couple of moments. It's a discounted benefit. They're a free rider. So what that means is that if you're unlucky enough to be diagnosed as, say, chronically ill, what we're going to do, what the client is going to do is file a claim. So let's say they file a claim for $1 million. Okay, we're going to receive that claim. We're going to take a look at the condition that they suffer. We're going to take a look at how that condition is expected to impact their life expectancy. And based off of those pieces of information, we're going to make them an offer. So they file a claim for $1 million. Let's say we make them an offer of $800,000. Right? It's a discounted benefit, because they're receiving a portion of their death benefit today instead of at their original life expectancy, which is the way the product was priced. So we offer them $800,000. If they accept the offer, we're going to reduce the death benefit by the full claimed amount, $1 million in my example. That's the discount. Because of the early acceleration, it's a discounted benefit. I already mentioned, again, 100% of the death benefit up to $1.5 million. The important thing to remember with these benefits, they're free on all the products, even the term products. 100% of the death benefit up to $1.5 million in coverage for critical, chronic, and terminal illness. That's one of the things that makes our term products unique, because when you think of a traditional term insurance coverage, it's just that. It's temporary death benefit insurance. If you die during the term period, then the death benefit is paid out to the beneficiary. What most term policies don't offer are any sort of living benefit. That's one of the things that sets these term products apart. Not only are they very, very competitively priced from an industry standpoint, but on top of being competitively priced, you also get access to that death benefit early if you're unlucky enough to become chronic, critically, or terminally ill. So that's one of the things to keep in mind as we go through the features of these term products today. The main features. So we offer coverage for up to 35 years. What we're doing with these term products is providing 22-level premium duration. I can give you a 10-year term policy, or I can give you a 15-year term policy all the way up to 35 years, any year thereafter. So I can get a 10-year term policy, I can get a 15-year term policy, 16, 17, 18, so on down the line, all the way up to 35 years. What that does, and then of course it's unique because you traditionally get, a 10, 20, or 30-year term policy or something along those lines. Be able to offer coverage every single year between years 15 and 35, we can really tailor the coverage for every specific client and for every specific insurance need. So if I have 23 years left on my mortgage, I can buy a 23-year term policy. I'm insuring that specific need for the exact amount of time that I need the coverage for. Whereas traditionally, I would have to buy maybe a 30-year term policy, which is more expensive and it's longer than the insurance need that I have. So by being able to offer those durations, those specific durations, we're getting that right need for the exact right price. And I'll show you an example of how that can be beneficial here when we talk about that bundling program in just a few minutes. We have junior and senior coverages available on these term products. Obviously, the coverage periods are limited for older clients. We're not going to write a 30-year term policy on an 80-year-old. We also have some attractive conversion guidelines here. We can convert the term policies to any of the permanent policies in the portfolio for up to 80% of the initial term period or age 75, whichever comes first, without evidence of insurability, and you are converting the free living benefits that we just highlighted a few moments ago from your term policy onto that new permanent policy. And last on the list here is the QOL Advantage program. I'm going to skip that for here. We'll discuss it in just a couple minutes in more detail. 0 to 80 are the issue ages. I just mentioned the term periods, of course, are limited for the older ages. From a juvenile coverage standpoint, the minimum term face amount is $50,000. $100,000 is the minimum for adults 20 and above. You can see the underwriting classes available there, and you also have the option to purchase a premium waiver rider and a children's term insurance rider for up to $25,000 on any of those term policies. So let's talk about the conversion rules in a little bit more detail here. First of all, like I mentioned, 80% of the term period. So if I have a 30-year term policy, I can convert that policy, that term policy, to a permanent policy anytime during the first 24 years, or age 75, whichever comes first, to any product in the portfolio without evidence of insurability. And I also am going to provide you a conversion credit on that new policy if you convert the term policy to a permanent policy in the first 5 years. So if you do this conversion from term to permanent in the first 5 years, we're going to provide you a conversion credit that's equal to the first year premium paid if you do that conversion. And we're going to apply that conversion credit to the accumulation value of the new permanent policy, just to give the accumulation value a kickstart. Now you can do a partial conversion. We'll provide a pro rata credit for the partial conversions also, again, as long as that conversion is done in the first 5 years. You, of course, can do the conversion after the 5th year, as long as you follow the 80% guideline or age 75. You only go get that conversion credit during the first 5 years. One thing I want to mention briefly about the conversions, and I don't think it's on here, is that it also is a little bit unique. So aside from the 22 different term durations, the juvenile and older age limit coverages, and all those things we've talked about, from a conversion standpoint, we do allow partial conversions on these term policies. So what that means, obviously, if you're doing the conversion from term to permanent, the new permanent policy is more expensive. This is priced at the permanent, whatever the pricing is for that permanent policy. So if you have $1 million term policy, you might not be able to afford $1 million UL or IUL policy. So what you can do is you can do a partial conversion. So let's say you've got $1 million policy, term policy, and you want to do a partial conversion. So you're going to convert $500,000 of that term policy to a permanent UL. So your permanent UL, the premium is based off the $500,000 for that new permanent policy. Now, what we're going to do, though, is we're going to allow you to keep that remaining insurance amount in force from a term perspective. So not only will you have the $500,000 new permanent policy, but you also would still have a $500,000 term policy still in effect for whatever the remaining term duration was on that term policy. So you still will have the full total coverage amount of $1 million. It's just that you'll have a portion of it to be the new permanent policy you converted, and the remaining portion of it is whatever you didn't convert, remaining in effect on that term policy. So that's pretty unique. Also, one other thing, though, on that term policy. So obviously, we're going to adjust the price on that new term policy to reflect the lower face amount, right? So you were paying $1 million term premium before. Now, if we go back to our example we've been using, you now have a $500,000 term policy left, so we're going to reprice that term policy based off the new $500,000 you have. But additionally, for that term policy, we're going to base that new price not at the time that you do the conversion, but at the time that the term policy was originally issued. So we're saving them premium on that remaining term policy from two perspectives. You would expect the perspective of paying the premium on now just the $500,000 that's left, but we're going to provide them a little bit more of a discount by basing that price off of whatever age they initially took out the term policy instead of the age that they've done the conversion. So when you're looking at these term policies, keep that in mind. There's really a lot of great features and benefits that you don't traditionally find in your normal kind of death benefit protection typical term policy. One of the other things that sets these term policies apart is our program. It's a Quality of Life Advantage program. What this is a bundle discount program. So think of it this way. Excuse me. We all save money on our home and our auto insurance by bundling it through the same company. So the thought process behind the Quality of Life Advantage program is that why not be able to save money on your life insurance policy for having more than one life insurance policy in force. We're going to provide those discounts in the form of policy fee reduction on the additional term policies, but we're also going to price those multiple policies based off of volume discount on the aggregate coverage. And I'll walk through in just a moment what that looks like so it makes a little bit more sense. So you can do this as a standalone, so what this means here is that you can do 2 or more term policies. You're going to receive the policy fee discount on the extra term policy. Or you can do something like have a UL policy and a term policy, or more than one term policy. And then you still would receive the discounts on that term policy. So you can do term and term, or term with other multiple term policies, or you can do UL with term. And you're going to receive the discounts either way. So it's not just with the term, but the example that we want to give will be. So you can just get an idea of how exactly it works and the true cost savings that it can provide to your client. So here's the discount. So the annual policy fee on the term policies is $75 a year. Right? So if you're doing multiple policies, if everything is the same insured, owner, billing, and application date, we're going to provide a full waiver of $75 on the additional term policy. So if I have 3 term policies, we're going to provide the discount on 2 of the 3 term policies, the $75 discount. We understand that not always is everything going to be the same. So if you run into a scenario where it's a different application date or the insured is different, so think about that. Maybe it's a husband and wife. We still will provide partial discounts on those multiple policies. So you can run into a scenario where you might not, where husband might not need 2 different term policies, but husband needs a term policy and wife needs a term policy. Well, if you do them together, like this, with this Advantage program, we're still going to provide a partial discount of $39 on the additional policies that you're running. Or for a $25 discount if the billing is different or the owner is different, the $25 discount applies. So everything is the same, the full waiver. If there's a little bit of, if there's any differences between the multiple policies, there's a partial discount applied to those additional policies that you can see here on your screen. The volume discount. So in addition to the policy fee waivers on the additional policies, we're going to price each of the policies based off of whatever band the total coverage amount falls in. So if I have 2 term policies and the death benefits are each $200,000, traditionally it's priced as 1 term policy at $200,000 and the second term policy at $200,000. But what we're going to do, obviously the more coverage you buy, generally from a banding discount, the lower the per unit cost of insurance. So what we're going to do in that example, if you've got the 2 policies for $200,000, we're going to take the total coverage amount in this example, which is $400,000, that would fall in our band 2 level. So we're going to price each of those 2 policies at that band 2 level. So there's a cost savings from that perspective as well, because we're pricing each of those policies based off an aggregate coverage amount. So the first band that you see there with the total coverage between $250,000 and just under $500,000. The next band is $500,000 to just under $1 million, and the highest band is $1 million and above. Again, the higher the total face amount, the lower the per unit cost of insurance on each of those term policies. Here's what that looks like. This idea is called laddering. This is not a new idea. This is not any sort of complicated or messy process. What this is designed to do is show you how purchasing more than 1 policy for different insurance needs could save your clients money in this Advantage program instead of just buying 1 overarching policy for 1 face amount to cover all the insurance needs. So here's the scenario. Dennis, 40 years old, preferring non-tobacco. He wants coverage to ensure his family is protected. Right? We all do. He's concerned about having coverage until his 2 children are finished with college. But he also is concerned about the remaining 21 years left on his mortgage. He wants coverage in place for that as well. So we've got a couple scenarios here. We're going to have 3 different policies because he has 3 different needs. He has 2 kids and he has the mortgage. So the first policy is a 10-year term policy for $100,000. This 10-year term policy is enough coverage until his oldest child is through with college. So the 10-year $100,000 policy is covering the oldest child through their completion with college. Now, if you bought this as a standalone term policy without any sort of bundle discounts or Advantage program discounts, that monthly premium would be $13.78. However, with the Quality of Life Advantage program, the premium is reduced down to $5.34 per month. The second policy is a 15-year $100,000 policy. This is the length of time it will be until his youngest child is completed with college. So this covers that second insurance need. Again, as a standalone basis, like you would have to do most everywhere else, you're looking at a monthly premium of $14.57. With the Advantage program discount, it lowers that monthly premium down to $5.43 per month. The last insurance need is for 21 years. That was the remaining length of time he had on his mortgage. $200,000 ensures that he has a full coverage amount in case something happens to him while he still has a mortgage on the house. Again, standalone, $29 a month. With the QOL Advantage program, you're looking at $23.59 per month. So if we look at this in total, if he would traditionally bought 3 separate term policies, he would be paying $57.35 per month. However, by buying the 3 separate policies this way with the Quality of Life Advantage program, that monthly premium is reduced to $34.35 per month. That's a $23 per month savings. Now, just from a basic level, $23 per month isn't a drastic reduction in premium. We understand that, but it adds up over that 10, 15, and 21-year period. A couple other things to point out here. He can purchase a 21-year term policy here because we have that flexibility of those 22 different term durations. Otherwise, he would be buying typically a 20 or maybe a 25 or a 30-year term policy. Also, with that QOL Advantage premium that you see on the far right-hand side, remember, that's based off the total aggregate coverages. So his total, he's got 3 separate policies, 2 of them for $100,000 and 1 of them for $200,000. So he has $400,000 in total coverage. So each of those premiums is based off of that band. What was that second band in that example I just showed you? So not only does he get the policy fee waivers on the additional policies of $75 a year, but he also, we're pricing these policies based off the total aggregate coverage amount of $400,000. So that's how you're getting the savings. That's how you're getting that significant premium reduction. So with that, so we've got the 3 policies, saving $23 per month. But the big number here is that over the length of each of those 3 policies, the 10-year term, the 15-year term, and the 21-year term policy, $23 a month over each of those 3 term durations equates to a total savings of $12,696. So if you would have had to buy each of those 3 term policies separately, or maybe one overarching $400,000 term policy, the premium would be a lot more expensive. We saw that. By doing it this way, by purchasing separate policies for separate insurance needs, saved them a total of almost $12,700. So this program, this Quality of Life Advantage program, can provide your clients with significant cost savings over the long term with their policy. Now don't forget, you still have all the flexibility. He could convert any one of those 3 policies at any time following those conversion guidelines that I just showed you a few minutes ago. 80% off each of those term periods up to age 75. You can convert any of them to permanent policies at any time. He also still has the free living benefits on all the term policies. So he still has $400,000 worth of living benefits in case he becomes chronically, critical, or terminally ill. So it's very important. So he still has all the features and benefits, all the flexibility. All we're doing is providing a bundled discount with this program for purchasing multiple policies for multiple insurance needs. So you should have plenty of applications that you can use this for. Doesn't have to be a scenario like this, but this is fantastic, right? We all know people that need mortgage protection. We all know people that have kids that they're worried about making sure they get through college or they get through some point in the future unscathed, so that there's coverage for those things. We all know a husband and wife who need more insurance coverage. Again, it doesn't have to be the same person. The numbers would be a little bit different because the discount would be a little bit lower for the husband and wife, but the idea still there is the same. And don't forget, we can write it on juveniles too. So if the juvenile needed coverage for any reason, any of those minors, we can add that to any of these programs or any of these policies for that bundle discount and still receive those discounts that we walked through up to this point. So lots of unique opportunity here with these term products. You've got the free living benefits that we talked about that are included automatically on all of the products, not just the term policy. You've got the 22 different term durations. You've got the attractive conversion guidelines. You've got the ability to do the partial conversion to keep keep the remaining term in force that you don't convert for a cost savings measure, and so you don't lose the coverage that you didn't convert, so you still have the total coverage amount available. And then lastly, of course, we talked about the Quality of Life Advantage program. So that was all I had prepared from a material standpoint for today from our current products. But what I wanted to spend just a couple minutes on, like I told you at the very beginning, we've got some exciting new product changes and enhancements happening very shortly. And I wanted to provide you a brief synopsis of what some of those main sticking points are. Now, I don't have any slides for this because it's not approved. They're not available yet, but I wanted just to kind of get this information on your radar so it gives you something to think about and be on the lookout for here in the future, so that you're properly trained on all these products and all the new features and benefits when they do come out. Excuse me. So first of all, those living benefits that I just showed you towards the beginning of the call, we're making some updates and enhancements to those. So right now I told you that the limit was $1.5 million. When the new products roll out, the limit will be raised to $2 million on the living benefits. Also what we're doing is we're adding guaranteed minimum payouts for the chronic, the critical, and the terminal illness. So right now there's no guaranteed minimums. Right now there's no set minimum amount that we have to pay out based off the way the riders are written today. they now, going forward on the new products, when they become available to you, will all have guaranteed minimum payouts available. In addition to, of course, you can get more than the guaranteed minimum, but there will now at least be a floor there for that for each of those living benefit riders. One of the other things we did was we removed the permanency requirement on the chronic illness. So today, on the version I just showed you, the condition, the chronic illness, in order to be able to accelerate that benefit under chronic illness, that condition must be expected to be permanent, as noted by a physician. That no longer will be the case going forward. We've removed the permanency requirement. So the client could become chronically ill, unable to perform 2 of the 6 ADLs. They could be expected to recover from that condition, but under the new riders, they would still qualify because it no longer is required to be permanent. So those enhancements are coming from an ABR standpoint with the new products. One of the other things that we've done is we've added a new chronic illness rider as well. And this will be a paid chronic illness rider. So it's an additional benefit that you can decide to purchase for the policy. And it's called the Accelerated Access Solution, or AAS rider. What it is, it's the paid rider. It's a dollar-for-dollar payout. So remember, on the free living benefits, it's a discounted payout for that acceleration because this AAS rider is paid. It's a dollar-for-dollar payout. You can elect to allocate between 50 and 100% of your death benefit to this chronic illness accelerated rider. Okay, so obviously the less amount you accelerate, the cheaper it's going to be. Also, the AAS rider has a max payout limit of $3 million. Remember, the free living benefits today have a $1.5 million max payout. The new version of those will have a $2 million max payout, but this new chronic illness rider, the AAS, on a $3 million max payout option. So in addition to being able to choose between 50 to 100% of your death benefit on the rider, it also offers 3 different payout options. So they can choose whether they want to receive 2% of their death benefit per month, 4% of their death benefit per month, or the IRS per diem limit. And that third option, that IRS per diem limit option, actually is exclusive to our products. No one else that has a paid chronic illness rider offers that per diem payout option. So that's unique. So if I choose, just for an example quickly, if I choose the 4% payout option, and let's say I have a $500,000 policy, well, 4% of $500,000 is $20,000. So if I choose that option, I know that if I become chronically ill, I can accelerate 4% of my $500,000 per month for $20,000. Unless that $20,000 in this example exceeds the per diem limit, which it does today, because the per diem is only $340 a day, which is $10,300 and some dollars a month. So in that example, you wouldn't get the $20,000. We can't exceed the per diem limit, so you get whatever the per diem is now. But if you choose the per diem option, if you choose that option, obviously the expected trend is that the per diem increases every year and increases over time. So by choosing that per diem option, it's a natural hedge against inflation and rising costs of healthcare, because at some point in the future, we go back to my $500,000 example versus that 4% payout option of $20,000. If I choose the per diem option instead, and the per diem limit is higher than the $20,000, then I would get whatever the per diem is at that time. Okay, and conversely, if the per diem was higher than $20,000, but I chose the 4% option, I would only get the $20,000 because that was the option that I had purchased. So that'll be new on the new product, an additional paid chronic illness rider protection. For the products, 2 new products. We have a new IUL product called the QOL Max Accumulator Plus. This product will replace the Index Plus 2 product that's available to you today. If you're familiar with the Index Plus 2 product, frankly, from a competitive standpoint for cash accumulation, it really is not all that competitive. This new QOL Max Accumulator Plus product is at the top of the table for competitiveness at our sweet spots, which is between 35 and 55 years of age. So number 1 or 2 in all cells between ages 35 and 55 in terms of max cash accumulation. So a drastic shift in competitiveness from this product, and frankly, a breath of fresh air, because now we have a IUL product that we can compete with anybody out there in the industry today from a cash accumulation standpoint. This product will have a lot of neat new features and benefits. For example, from a high-level standpoint, about 4 strategies. The Index Plus 2 today has only 2 strategies. But I have a rider called the Select Income Rider. This is a no-cost rider, and basically it's a spread death benefit rider. There's one other one out there in the industry today. I believe Minnesota Life offers it. What you can do with the Select Income Rider is you can choose to spread anywhere between 10 to 100% of your death benefit out for 10, 20, or 30 years to your beneficiary. So rather than the beneficiary getting your $1 million death benefit in a lump sum, you can elect to spread that $1 million out to the beneficiary over 10, 20, or 30 years. Now what that does, a couple reasons. Number one, it could help the beneficiaries manage expenses instead of getting $1 million all at once and spread out. They might not like that, but what it also does from a time value of money standpoint is we don't have to pay that full $1 million out all at once. If you choose to utilize that rider, it lowers the internal charges in the policy, which means that it increases the cash value, thereby increasing the loan amount available for that supplemental retirement income. So even without that rider, we're at or very near the top of the table in those sweet spots from 35 to 55. You add that rider on there, and it simply boosts or separates us even farther from the pack in terms of max cash accumulation. So this is a fantastic product. Be on the lookout in the near future for more information and training, as well as material surrounding this product, because we can't wait for it to hit the street. We can't wait for it to be available to you. Frankly, it's the best accumulation product out there in the industry today, or it will be once it's available. The second new product we have coming out is a new NLG product. So today you have the QOL Guarantee Plus product. It will be replaced by the QOL Guarantee Plus 2 product. So not as drastic of changes on this product as there are on the IUL product. However, there are a few key features. We've shifted the target market of that product to ages 55 and above, guaranteeing the death benefit to age 105. So if you're 55 and above, guaranteeing the policy to 105, it's the most competitive it can be. It's still competitive at other ages, a little bit lower, younger ages, but of course when you're talking about an NLG product, typically the demographic for those is 55 and above anyway. And in every cell from 55 and above, the new product is cheaper than the current NLG product that you have available through us today. So we've repriced it. We've made it much more competitive from a premium standpoint. But it also has a couple other neat new features on it. First of all, it has a return of premium option. So it has a free return of premium rider on it that will allow the client at 2 different times in the policy to decide whether or not they still want the coverage. If they don't want the coverage, they can surrender the policy either at the end of year 20 or the end of year 25. If they surrender at the end of year 25, they get 50% of their premiums back. If they surrender at the end of year 25, they get 100% of their premiums returned to them. If they do a full surrender through this return of premium rider, free rider includes automatically on all the policies. Additionally, the same great features that we have on our GUL today still remain in effect. So aside from being even more competitive from a pricing standpoint, we still have all the flexibility and optionality that all the other no-lapse guarantee products in the industry today do not have, and that being guaranteed cash value. So this product has guaranteed cash value that you can withdraw from the policy without impacting the duration of the no-lapse guarantee, which of course is very, very unique from a no-lapse guarantee standpoint. Typically, a no-lapse guarantee product has little to no cash value, and if any of it is accessed, it drastically shortens that guaranteed duration. Not so with our product. The cash value in the product is guaranteed. You can access the cash value inside the product without impacting the duration of the guarantee. And of course, both these new products have the new ABRs that I talked about just a few moments ago. So some new exciting changes and enhancements. Again, be on the lookout because we'll have training for that product as well as the IUL product and the new ABR enhancements. We're very, very excited for you to see these. We can't wait for you to get your hands on them so you can start selling these to your clients. With that, folks, that was all the material that I had prepared today. I want to thank you so much for your time. We look forward to doing business with you, still obviously continuing to do business with you. And we look forward, if you have any questions, certainly please let us know so we can address those for you the best that we can.